Hi, this is Randy Finney with Right Side of the Chart. This is a mid-session update for Thursday, September 10th, 2020. We'll start out with coverage of the broad markets, take a look at that, update the indexes as well. I covered posted the charts of the futures this morning. I want to talk on those potential bull flags, and I'll cover the index ETFs as well. The VXX trade, I want to do an update there, and brief update on gold and silver. That'll be it. All right, so what we have, or we had overnight, is the formation of, again, what I refer to as potential bull flag patterns. You could probably tell from my, the opening sentence in that post this morning, I'm a bit skeptical with everything, all the whipsaws that we've seen in recent months. The markets have just had, heavy hand with the Fed involved in the markets, and quite a bit of whipsaw signals. So again, take it, they are what they are. They're breakouts. But as of now, and that's why I wanted to do the update at this point in time, it's no longer the ideal scenario. The flags are still intact. What I'm referring to, a bull flag consists of a few components. You have the flagpole, which is an impulsive, nearly unidirectional, meaning almost straight up rally, leading up to the formation of the flag. The flag then takes a form of a downward shape, like a flag on decreased volume that occurred overnight. So volume is going to be lower. I don't even need to add it on this chart. And then you want to see the flag break out, and the measured target for a flag pattern doesn't mean it has to hit that, but that gives you a pretty rough estimate of where prices may go, and you'd be surprised how often these flag estimates, the projections, the measured targets play out. That was the distance of the flagpole added to the lowest point of the flag before it breaks out, and that had us going, I think, right up here to about the top of my bounce target zone. Again, just to reiterate, my projections of bounce anywhere from the 50% to the 61.8 fib, or up to this, support resistance zone up here about 11,940 to 1210. They're in close proximity, and the trend line here. This is our primary uptrend line. Now, that's where by the charts, by the technicals, that looks ideal. It fits with the flag scenario so far, the impulsive buying, the positive divergence, everything else. Probably the one thing that I don't like about it, it's almost too easy. Same with the flags. They're almost too obvious. The market doesn't do easy. It has for quite a while now with, Fed pumping it full of liquidity. Dip buyers have been rewarded for months buying every little dip in the market. But well, this one, this is what happens. Eventually, you get a correction. Remember, this was a drop in QQQ over about 11%, and I think a little bit better that in the future. So what happened is, a lot of dip buyers got burned if they were buying 1, 2, 3% pullbacks. They got underwater, and that's where you get that final washout. They get stopped out. And so what it does put a little bit of a check in the bullishness in the market. Now, I'm going to cover a lot of things right now, and not a lot of things. It won't be a very long video, but I want to talk on the put to call ratio, the VIX again, some of those sentiment indicators, because as I said the other day, one thing I'm not seeing here is a lot of fear. There was obviously some fear. We did see a spike in the VIX. We did see a spike in the put to call ratios, but not a huge spike, and not one that's typically indicative of the end of a correction. All right, so the flags so far, they broke out, but a textbook, and again, you don't always get what you want, but a textbook bull flag pattern has a breakout and move up being equally as impulsive is the move leading up to the flag. And so if I zoom in here, which I'll have to do so you can see it a little bit more clearly, we were off to the races after the flag broke out, but we all of a sudden got checked. There's a big red reversal bar right there, and we're testing the top of the flag. I mentioned that today, if you're trailing us up, again, the market's not going to make it super simple for everybody. This could be a little washout move, and it is a back test of the top of the flag, so we could certainly continue on. Again, it's just not ideal, but as long as we stay above, I mentioned earlier, if you're trailing this move up, if you're long, trying to game the counter trend bounce, or let's say you're looking for new highs, one thing you could do is set a stop below the bottom of the flag. If they take that out, that's a major reaction low. That'll probably open the door to another wave of selling. Again, probably a lot of stops placed below that low right there. And that's NQ. Let me just zoom over to ES and RTY, and I'll cover the ETFs. This is ES. I'll zoom in a little tighter for you. Again, the main catalyst for the rally, or for my expectation for a rally, positive divergences. Index is falling to support levels and reversing off those support levels, and so far, pretty impulsive move off that divergent low, followed by the flagging action here in ES. ES popped it, but so far back testing. Again, maybe it'll have a successful back test, move on up. Maybe it'll zigzag higher. Not all bull flags play out perfectly like that. And again, depending if and when you bought, if you are long, you can set stops anywhere. And if you're short, or looking to get short or add on, I'm still at this point in time favoring those targets I listed. Again, I think on pretty much the 50% and 61%, 61.8% Fibonacci retracements come in with my price support levels about right here and here. So this is still my minimum bounce target zone, potential bounce target, and I think the flag on ES projects even higher, maybe up here at about the 76.4 fib. My primary focus remains on the NASDAQ 100. That's what it's all been about. Make no mistake about it. For months now, it's been nothing but the FANGs. They've been leading, outperforming, significantly outperforming, where we've seen deterioration in market breadth, internals, and for the most part, the FANGs have just been where all the money's going. And the big drop that we had recently in the NASDAQ 100 and QQQ, that it was 3-day drop of 11% in QQQ, and that is indicative of a crowded rush for the exits. That's what happens when everybody's buying big tech, and then all of a sudden they flip a switch, it goes the other way, they sell those names, and it's going to cause that quick drag down in the indexes. And we got to be on watch for another leg down. I think one's coming, but I do favor a little more upside here. So that's it. There's ES and the targets and the flag. I just want to show you that kind of stuff and what happened since I posted up early this morning, that little jog back. That may be a washout move. I have no doubt that there are going to be some trap longs that bought here, especially Tesla, Apple, those kind of stocks after the split, that are going to be using rallies to sell to get out of their positions, realizing, hey, this isn't the guaranteed casino or ATM I thought it was. I thought you can put money in Tesla or Apple and you're guaranteed, because those stocks are solid. And they learned the hard way. So there are going to be those people selling out on the way up. The $1,000,000 question is how much of that? It's possible we continue on to make new highs. I'm going to play this as I always do. I always say the markets are dynamic, and so is my analysis. So I'll be looking at things like market breadth. I'll be looking at those leaders, the FANGs, Facebook, Amazon, Apple, including Tesla, Netflix. I'll be looking to see how they act as they come back to resistance levels. There's a lot that goes in there, but and then anything else, any other potential red flags. I'll watch the financials and the other sectors and everything else. But as of now, I'm still favoring a little more upside here. And at that point, either outright scale out or close out my long positions. And again, I'm just talking as an active trader. Swing traders, as I mentioned, we had some pretty big drops, and I think another leg's coming. So if you're looking to short or you're already short, and you'll have to also use stops and decide where to use your stops. Again, we shouldn't go much above my upper bounce targets, or it's going to open the door to a move to run at those previous highs. And then RTY, small cap ETF. You've had the same thing. You had your flags right here. There's the Russell 2000 small cap futures. There's your flagpole. Measured target takes us up about my 115.55. That was a former downside target before. We had a sell signal right here. That was an objective short entry. We back tested the breakdown level here, and then a nice drop in the small caps from top to bottom. That was about not as much as big tech. It was only about a 7% drop. And so far we've rallied off this divergent low here. And again, we're at resistance. You can see all the levels. They were support on the way down. They become resistance on the way up. And the divergent low, especially during a primary bullish trend, tells me the risk reward is favorable to be long, not short. If we're in a primary downtrend, divergent lows often tend to fail or not result in much of a rally. You get little false signals. And as of now, the primary trend, at least off the March lows, is still bullish. So you have to put, you have to respect these divergent lows at the very least. And finally, on that, should we turn around soon and just crap out with just a minor bounce and then burn through the divergences? Well, what that's going to tell me is a change of character in the market. And that's something I'm certainly going to be watching for. And might even if I don't hit my price targets on my longs, I may jump back in, again on the active trading count into shorts. And of course, at the end of the day, I'm still very diversified. I'm still very much, especially my long-term positions, still like the ag commodities. They've just been, that's been the place to be for me. It's my, safe place, comfort place. The risk-reward profiles in the last couple months were just much better than the stock market. And all those ag commodities are well off the lows and doing well. A couple of them need to take breather here or there, and a couple of them have, but a lot of them continue to run up and are at or near multi-month highs. All right, let's look at the ETFs, and then we'll move on to this one, VIX. SPY. All right, let's just focus right now on near-term stuff. Well, we can start out. I was on the daily chart. We'll start there. We're below the trend line, and when I look at the daily charts, let me turn off all the lines. I just pointed out potential bull flags on the 60-minute intraday time frames, but the more significant daily time frame. What I mean by that? Well, what happens on the daily time frame supersedes or takes precedence over things that happen on the 60-minute time frames. And what I'm looking at now is an impulsive drop off the highs, 3 big red candles, and what appears to be potential bear flagging action, and it meshes with the volume criteria. See the 3 big volume bars, and so far the rise has been on diminishing volume, and that would project something like this. And we're also, I can say this, if that is going to prove to be a bear flag, now you'll know, well, one thing you'll know, what you want to look for is an impulsive breakdown through the flag. You want to see a breakdown below the bottom of the flag, this trend line here, and ideally you want to see impulsive selling afterwards. And just like a bull flag, a bear flag works the same way. You take the flagpole, that's the the move down, add it to the highest point of the flag, and it gives you a measured target. And look where that comes in. That comes in right at that 318.30 level. I had it color coded blue way back here, all the way back in July, saying this is the level we needed to break to get a decent sell signal in the market, and it held. We held that level, we traded sideways, and the uptrend continued. Then I was monitoring, I colored this uptrend line as blue, saying, well, now we need to take out this trend line. We're so far away from the 318.30. This now will be our next, this is the level I needed to see go, and that went. So bottom line is we've got a sell signal on the daily that occurred right here. Breakdown, follow through candle. We have a little kickback rally that is a potential bear flag. So if you hate contradictory analysis, I don't know what to tell you. I'm looking at the 60-minute charts, and they're saying, well, bullish trend, bull flags, divergent lows, we could rally, and I'm still leaning that way, but this would make me change my mind pretty quickly should we break down. And if we do, and that's why I do these videos in advance, it gives you a target. I like to get these things out in advance, so if that scenario starts to play out, because remember, in just 3 days the S&P 500 fell 7%. Remember, the NASDAQ, it was much more. Tech heavy QQQ, and that can happen again. So you can't wait too long. If you waited to day 3 and that's where you wanted to short, well, guess what? You short at the wrong time. And that's what happens. And so you got to really, you got to be quick. And we had the sell signals that were given, that day, the day the market started to correct early on, and that was the objective time to short. And this was the objective time to either cover those shorts if you're an active trader, or reverse and go long, but not to start shorting. And especially, again, QQQ. When we look at QQQ, let me turn off all the lines, and you can see that what looks to be and very well may prove to be a bear flag pattern. There's the impulsive leg down, take the flagpole, and here's your bear flag pattern. And so again, ideally this would have to break down later today, maybe a late day dump, or tomorrow. Why? Because the symmetry of the pattern, you really don't want to see something like this. The bear flag doesn't look like this. That would be the flag would be too large in proportion to the flagpole. Right now it is, at least the way I like to see these things, it's symmetrical, but it's getting there. It would need to break down again soon, maybe by tomorrow latest, I would think. and you know, measured target would drop us quite a bit. Here, let me turn back on the lines here. Let's see what the measured target would do. That was a drop of, I'm going to measure it out for you first. Well, let me add the measured target and then I'll measure the drop. Like I said, I believe it was 11%. There's the flagpole, top of the flag, and that would take us down. Same thing. Remember, I just talked about SPY going back for months. This is a level that SPY needed to take out back in July, and the same thing with QQQ. It never did. I had the blue line there. It held that blue line support, and then just like SPY, added the uptrend line because we got so far away from that. But that would take us down to that. And again, it was a key technical level because it was a breakout back there. It was a breakout on SPY. And so to just make it very simple, those are, you know, my current swing targets should this rally be capped soon, you know, on a back test of the trend lines, you know, those levels that I'm looking at. If it proves to be much more than that, then we'll probably make a run at and maybe even take out the new highs. But as of now, I'm favoring something along these lines. So I can say this too, we're getting a lot closer to the objective shorting areas because we're getting close to the trend lines, we're getting close to my minimum bounce targets, and you know, whereas 3 days ago right here was not a good time to be shorting, to add shorts and start new short positions. Today is much better. I mean, you know, look at it this way, you're, you know, when you short, you want to short at higher prices, just like when you buy, you want to buy low, you know, sell high. When you short, you want to short high, or, you know, sell high and then buy low or cover low. That's what you're doing. And so far we've bounced almost 5% off those lows. And again, you can see the drop right there. If I grab that right where we were, we closed on that day right there, and then the 3-day drop took us down, yeah, about 11, almost 11% right there into the lows. All right, so that's it. We're getting close to the minimum bounce targets on QQQ and SPY. The QQQ targets were, I have the 50% Fibonacci and the 61/8. These are the dotted lines right here that line up with my the price targets I originally posted, which was a move up to backtest the trend line and or that 286.32 price resistance, which comes in almost perfectly with the 50% fib. So that's minimum target there, or call it T1 on the upside. Remember, these were the downside targets right there, and still that fifth target, which, let me see for kicks and giggles, if I draw draw out the flag here. Remember, we're on a 60-minute chart, but there's your flag. Here's your flag pole. Here, I'll color this up just so it stands out. I know this chart's starting to look like a Christmas tree. Okay, I made it this purple color, which measures the move down, that 11% or so drop. There's the top of the flag. Assuming we broke down soon, guess where it takes us? Right down around to my potential fifth target zone. So there it is, guys. It's so bigger picture. If you're not an active trader, I'll say it right now. The market's up today. It's been around the last few days. We're not all the way up, but we're close enough where I think you could start scaling in to short positions for that next leg down if you are of the mindset that that's coming. And if you're not, if you're bullish and you know, bought here or bought wherever or rode out this whole thing, then you know, consider a stop at the very least below the recent lows. And as I said earlier on the futures, those flags don't show here because these trades do not reflect what happened overnight. The best I can do is turn on the pre and post market trades, and that might give you a little bit of it, and it's kind of sloppy. So let me turn that off. To chart properties, that's it. Okay, quick look at SPY on the 60-minute chart. Right now, we've run into today, you know, these lines might be hard to make out in the video, but there's a 38.2 Fibonacci retracement level, which is typically about a minimum that you'll see on a counter trend bounce. And if here's the dotted line right there, the dash line, I'm just going to use that as a horizontal line. So to the button, we hit the 38.2 fib, and that's where the sellers stepped in today. I was leaning towards a bounce up to at least a 50, or if not the 61/8 fib, which come in around my 345.27 and just below my 349.50-ish resistance level. But remember, well, let me say it this way: I'm starting to lean more towards we could be over. The bounce could be over. Why? Again, because of the trapped long situation. This was an extremely irrational, one-sided market. A lot of retail traders, we know that, and it's not just my opinion. These are articles published, TD Ameritrade and Robinhood, they publish what their retail traders are doing, and it was a retail crowd just couldn't get enough of those big tech stocks and FANG stocks, and hey, no offense, I'm a retail trader. I don't do this. I do it professionally for my own account, but not for others. So put me in the dumb money category is what I was going to say. Retail traders are known as the dumb money. Now they're trapped, and so when you get trapped traders, sometimes they'll ride the trend up, but they start to sell out here, and we could reverse at any time. And as I'm doing this video, you can probably hear it a little bit in my voice. I'm starting to lean towards that scenario, very open to it. And one thing that may make me change my mind as to how much further I hold out is what happens here on the very near term, the intraday charts. This is today right here, the open SPY right there. There's the open. We ran up, we had a swoon down, and then we made up so far a lower low. So this was the opening, the daily high right here. We had a pretty heavy wave of selling hit. We went up, and so far we've stopped short. Now, if we go back down, we undercut this low, that's going to be pretty bearish. It's going to open the door for more selling. It's going to foil those flags. QQQ, you can see the same thing here. So today's pop out of those flags, it was impulsive, but it was met with a lot of selling, pretty impulsive selling. There's even on the 1 minute chart, the same technicals that work on daily charts, 60-minute charts work on the intraday. There's a little impulsive leg down, a little bear flag, and then the move down out of that flagpole. So here's what I'm watching very short term if you're an active trader. Bulls need to take this level out. They need to take out today's reaction high. We take out this low, that's not going to be good. And we may have seen, this may have been the end of the run right here. So you'll have to, adjust accordingly. Like I said, I think it's already a decent time to start scaling into or back into short positions for swing traders because, it's all about risk reward. If that doesn't make sense why I'm talking about that, if I'm thinking there might be, let's say from where we are at today, QQQ, so my minimum bounce target was up another 1.5%, that's my point, and maximum bounce additional upside of about 4% from where we were today around the highs. Is it worth milking out an additional 1.5%, maybe 4%? If I believe the market's dropping, going to go down another 11% from here. No, that's what risk reward is all about. It's not worth risking, $1 to lose 10 or something along those lines. And then for those of you with a different mindset that this market's going to new highs, it's simple. There's little price support right here on QQQ. There's at lows. You can go long here and just don't fall in love with your long positions. That's going to be bearish if we break this intraday low right here, not low but a minor support level about 277, 278. Certainly be bearish if we break that. So you can put stops just below those levels if you think we're going to new highs and beyond. It's more and more I'm leaning towards the fact this rally may be over. Okay, now let's talk sentiment. Because that plays largely into my analysis, and the VIX is one way to show. The VIX is simply a measure of put to call buying. It uses that. We're going to look at put to call ratios, but that's what it's factoring in. And it often is a coincident indicator with the stock market, meaning it'll rise when the stock market is correcting, but there are times where you get some predictive value in it. And back here you can see before COVID hit, you can see the VIX broke out in late January. There was a breakout of a well-defined downtrend line, bullish falling wedge, positive divergences, everything I like to see, watch, rinse, repeat. That's like we had here. Sometimes you break out and that coincides with a breakdown in the stock market and a sell signal, and you get these quick rallies in the VIX. And again, don't underestimate, it might not look like much log scaling. These are well into the double-digit gains, triple-digit gains on a lot of these. But that's what happened. So you broke out, and then there was an abatement. The VIX fell back and then exploded. A near back test, not all the way, but a near back test. This is the current wedge. In fact, we had this breakout first. This was the minor downtrend line with your primary downtrend line right here, and there was our breakout. So we we entered the VIX at after the breakout. I waited, to be safe, wait for breakout above 26.89, which we got. That was good for, I don't know, whatever it was. We hit T1 quickly, 20% plus, I don't know, somewhere in there. We went a little higher, but you can see, the whole point, the reason I list additional targets, each target is a level I expect a reaction. So as I said the other day, the stock market doesn't go from firing on all cylinders as it was just a week or two ago to free fall mode. I don't recall ever seeing that happen. It's usually some kind of initial correction, initial leg down, and then likewise, that's why the VIX usually doesn't just explode and continue up. Usually, go back last time around, like I just showed you here, there was, the breakout right here was impulsive, a gap up, some rally, and then the corrective phase in the VIX, and that probably coincided with a additional one last thrust up in the stock market, give or take. And remember, the VIX was rallying in advance, even when the market was going up, which I was saying at the time, that's a red flag. That's telling us something. And then boom, the stock market correction started. And again, each price target is a level where a reaction is likely, and that's why I list those. So active traders can recycle back in. You could have booked profits there. We had the stock market at support with bullish divergences. We got the bounce. The bounce in the stock market is what caused the VIX to come down. Now it's come back down to our original buy trigger. We're still well above the stop. I put the suggested stop at 24, and so therefore, at any point in time, I think we'll get the next leg up. It could start today. Told you I'm kind of leaning that way, even though I started out the video saying, look, I was leaning towards these upside targets, but as I started the video and I'm watching the intraday action, I watch those flags, those bull flag breakouts start to become foiled with a back test of flags. I don't like to see that. So, it's kind of videos almost being done in real time where I'm, kind of change my near-term outlook on the market and put now higher odds that we may fall short of those some of those bounce target zones I gave you yesterday, and as well as I reiterated this morning. As I said, charts are dynamic, and so is my analysis, and so that's it. So whether this is it for the rally in the market or not, I can tell you, and again, just like the VIX was rallying here while the stock market was still going up, we could see more upside in the market. Maybe my targets, minimum and maximum targets, do get hit in the indexes, but yet the VIX starts to rally here. That would not at all be uncommon. In fact, I would almost expect it because I haven't seen a big enough surge in this, and I think if stocks continue to rally, people are going to start buying more and more put protection, which is going to cause this to go up. So I just want to reiterate this trade. I still like it, and just like we're getting about that level where you can start scaling back into short positions, I think this is a level where you can, if you took profits, you could recycle back into the VIX. And I would also add that if that starts to materialize, another leg down the market, we take out the recent lows, we start to see some impulsive selling. T1's already been hit, so I don't even expect it to be so much as a hiccup. I think we'll go right through there and hit at least T2 and more likely T3. We might even go through T2, and I may add additional targets. And like I said last time, we caught this. We went long. It was an official trade back here at the time. I identified the top in the market and this bottom in the VIX, and we were long there, but we took profits. Actually, we were using TVIX. I take that back. Before TVIX imploded, we got the last good run out of it and took profits too early. We hit my third or fourth or whatever my final target was. I forget what the return, 66, 100%, whatever it was, well into the double or triple digits. But this kept going. There was a lot more meat on the bone, and the point was, in hindsight, I should have made that official trade when we came up and hit my final target. Should have just raised stops and let it run, and that would have put a lot more money in our pockets on the official trade. And what I'm saying that for, and you know what, I actually might have mentioned that at the time. Official, unofficial, I try to manage these trades. It gets very difficult. I haven't updated a lot of the trades in ages. But I'm going to tell you that right now as I'm doing the video, same thing holds true. If the market starts to take another impulsive leg down, I'll post my thoughts as I see them, any significant developments, but you may want to do the same thing there. In other words, just let it run. If the VIX is ripping and VXX is going up, you might not want to book full profits there. You might want at that point, as we approach the $43 level, raise your stops to whatever it is, 35, right around this T2 level, and maybe target that 50-70 level. That's a potential fourth target right there. Okay, and on the put to call ratios, the two that I've been highlighting in recent weeks were the CPC, that's the total put to call ratio index. It's a measure of, it's a ratio of put to call buying. When it hits extreme lows, you have very few people buying puts, a lot more people buying calls, meaning the majority of market participants are bullish. It's one of my favorite sentiment indicators. A lot of people like to use the AAII, American Association of Individual Investors, as a written survey. They get a poll every week. Hey, are you bullish or bearish on the market? Where do you expect it to be in whatever, a month, 3 months from now? And that is that could be rhetoric. I might say I'm bullish on the market, or I might say I'm bearish, but it may not jive with my positioning. I might be in cash. I might say I'm bullish, but yet in short. So again, this is people putting their money where their mouth is. When you use this indicator, it is showing you what people are doing in the market, not what they're saying they are doing or what they think the market's going to do. And so therefore, I find it more accurate than the AAII survey. And this tight cluster readings have been highlighting. Those are usually followed by double-digit corrections. And so far, as I mentioned, we had a better than a 10% drop in the NASDAQ 100 off here. Now, is it done? This is why I'm doing this. That's the million-dollar question. Well, let's take a look. We had this. Let's go back to a few of them here. When we had this tag right before COVID, it all wasn't said and done until we hit this extreme. We hit my buy point. When we spike to this green line, that's when excessive fear exists. You want to go long and cover your shorts. And had you done so each time that green line was hit, you would have been paid off very well. Right there, and that might have been, nope, that one was, actually that came there a little early. I have to draw that line down. I think it was, might have been right here. Either way, it shows you where they are, and it is a pretty accurate indicator. Just like these, sometimes you get the one and done tags like we had before COVID. Sometimes you get the cluster readings before the corrections come. And my point is, from those previous extremes, you came up quite a bit afterwards. You didn't always come all the way up here. Sometimes you'd have a drop. Here's one, for example. Well, yeah, we had that 10% drop after that reading, and then we did get up to that line. So what I wanted to point out is at this point in time, all we got up to is right here, about the just above the 1.0 level, about even put to call buying. And my even better track record we have on the CPCE. This one has 100% track record. Using my red line of my sell signal, extreme bullish complacency. You can see the big drops every time that level was hit. Without fail so far, and we have, this is still a cluster. These are all in close proximity. So is it done? These were bigger drops. As I mentioned, we had about 11% drop in the NASDAQ 100, but a little more than half of that in the S&P 500. So I don't think this excessive bullishness is played out yet for the full correction. Maybe it has. I just don't think so. You can see the 10-day moving average is down at levels we really haven't seen throughout the entire bull market. So it just shows you a lot of folks are buying, especially when it comes to the equity-only put-to-call ratio, a lot more call buying than there is put buying. And then what happened recently? Well, they got scared. They got a little bit. They started buying some more puts, a little more put protection on their positions, but not a lot. The last time we hit that level, this drop here, that was probably double digits or close to it, if not more. We spiked all the way to this level shortly afterwards. This time we hit it here, we spiked and we kept going up, and before the correction was over, we almost reached that green line right there that I have. This time here we hit it. We had a spike up to about this level. So that's the minimum over the past decade that we've hit, where it took that much put buying to put a floor into the market. Because when you have a lot of put protection, the market's only going to drop so far. When you have very little put protection, as evidenced here with all the call buying, it opens the door for a bigger drop. So these are things that I'm looking at that in time, will they prove right or wrong? Nothing's 100%, but to me, they're indicating that regardless of what happens here today, tomorrow, next week or so, in the coming weeks, and even months, most likely there's going to be more downside in the market because things are out of balance. They were, the Fed has created, in my opinion, one of the worst bubbles in the history of the stock market. And, I'll say that, and I don't think that's hyperbole. I think it's one of the biggest bubbles ever, with the false belief that they said they're going to do what it takes to shore up the financial markets. I believe that, and I believe they'll try everything they can do. However, where I think I differ with the retail crowd that's buying stocks like they can't lose is that they actually have the power to prop up, indefinitely prop up the financial markets. I don't think that's that there's. I think there'll be unintended consequences for the excessive money printing and interventions in the financial markets, like the shoring up the bond markets, destroying price discovery in the corporate bond market. I mean, that's huge. And when institutions and individuals and pension funds and all that cannot accurately assess the default risk of a bond, or credit, it really undermines the whole financial system, in my opinion. Okay, long video, so I'll breeze through the dollar and gold and silver, since I said I'd cover it. We broke down. That's it. There was that bearish rising wedge yesterday, highlighted in the U.S. dollar, as well as the 93.199. That value may have changed slightly. This charting platform rolled their futures. If you notice, the one, it would have been, I think, the September contract yesterday. And once they roll the continuous contract to the next one, which they did, they no longer populate. They don't load the charts of the old contract. And what they do is all my trend lines are lost and the levels change. Now the downtrend lines and uptrend lines are going to be the same. Price levels may have changed slightly because now we're looking at the December contract. So I replicated the lines, and that's it. We broke both the rising wedge pattern. We broke below the back test of the trend line, and we broke below that price support. We're trying to back test it, maybe a whipsaw, but as of now, that is a sell signal in the dollar, and that is bullish for gold and silver. And likewise, and not by mere coincidence, gold broke above took back the uptrend line and broke above that 1951, 1952 support level, which should open the door for a move up higher, unless all this proves to be a whipsaw signal. As of now, take it on face value. That's it. Dollar broke down, gave us a near-term sell signal. Gold broke out, near-term buy signal. And silver also broke out above the 27,308 level. These, they haven't rolled yet. I'll zoom in a little tighter there for you. But they're all back testing right now. So, watch it. If they don't hold the back tests and they fall back down, then that's going to be a whipsaw signal, and that would be quite bearish. But this scenario, if it holds, would mesh with the market rally being over. If gold and silver start to rally, the dollar takes another leg down, gold and silver head up, that would mesh with the stock market rally being over, close to it, with gold and silver catching another flight to safety bid, and stocks starting to move lower. Okay, long video. We'll wrap it up here. And again, like I said, consider me right now at this point in time increasingly near-term bearish. Like I said, I'm still open to the possibility of those upside targets being hit. We haven't taken out today's lows yet. If we do, that's just going to increase the odds that the rally may be over, and we might be ready to take the next leg down. And on that, whether that happens or not, just keep in mind that if and when it does, it will probably be very impulsive, just like the initial leg down, especially if those bear flags, potential bear flags I laid out on the daily charts play out. So the takeaway from that is, either you line up your ducks on a row, the trade ideas that you want to trade, identify your targets in advance, your entry points, your stops, but then you got to move fast. And if you don't know what to do, I always say stay out of the market. Watch. There's nothing wrong with being in cash right now. Things can go the other way. We've had a extremely strong bid for months. Sell signals have been ignored, or they play out for just a little pullback. So who knows? It's really hard for me to gauge, because the Fed has pumped so much liquidity into this market, and it's defied technicals for quite a while now. So I told you where I think things are going to head, and we'll just have to adapt to these levels, adjust if and as these support and resistance levels and chart patterns are taken out. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.